Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. It is that time of the year when we're looking and talking taxes. Yes, tax season is around the corner. But apart from all the changes that have happened with respect to how you will file your income tax, the link of Adhaar and PAN, a lot of other interesting things have also come about. For instance, some clarity on what happens to the long-term capital gains tax liability in case of ESOPs or bonus shares. This was an issue that was raised during the budget this year. So now that we have the clarifications coming in from the authorities, we thought we'll get in the experts to explain and simplify all of this for us. Archit Gupta of Clear Tax joins me on the show, as does Harshvardhan Rungta. So Archit, let me come to you first. And what is the clear takeaway now after the latest statement from the Apex Court with respect to filing your income tax for this season?
Right. So we'll have to first go back to the history a little bit, like that the government came out with the amendment in the finance bill saying that whenever you are filing an income tax return, you have to quote the Aadhaar number you have or the application number of the Aadhaar that you have made on every tax return or the PAN application that is made. And they were looking to retrospectively cancel the PAN in terms of if the Aadhaar is not quoted. So the Supreme Court recently came out with the clarification as citizens really raised privacy concerns with the Aadhaar, and that has led to the Supreme Court coming out with a clear view that if you have an Aadhaar number, you must you must quote it after July 1 in your income tax return along with the PAN. So it basically links the Aadhaar to the PAN post July 1. If you're filing prior to July 1, there is no requirement to quote Aadhaar prior to July 1, because July 1 is where the provisions start to apply. If you have not applied for an Aadhaar, then you are not required to apply for an Aadhaar just for filing the income tax return even post July 1. So basically, if you have an Aadhaar, you must quote it with the tax filing and link it to the PAN. If you don't have an Aadhaar, you don't need to go in and apply for Aadhaar just for filing. And it has referred the matter to the Supreme Court has referred the matter to the constitutional bench to come out with a view on income taxes and Aadhaar. But for now, it is clear that if you have a Aadhaar, you have to quote it. If you don't have one, you don't need to go apply for one.
Okay, Harsh, your understanding of this entire matter that's been going on and this concept of linking both the documents, the PAN card and Aadhaar, I don't know, have you done that yet? I know I haven't, but I think, when we're talking about the linking, then what are the things one needs to keep in mind?
So, well, Surabhi, if you see initially when the mandate had come that you had to link your Aadhaar and PAN number, you had to log in into your portal on the income tax portal. You log in your account in the income tax portal, and then you had to go through the exercise of linking it together. Now there was a glitch over there because there were several instances where the name as spelled in your PAN number was different vis-a-vis it was spelled in your Aadhaar. For instance, you had say Harshvardhan Rungta in your PAN card and Harshvardhan H Rungta in my Aadhaar card. So that is the middle initial was there. So it was not possible that we could link it together. But over time, Income Tax Department has gone ahead, and we don't now need to log in into your account. There is a link at the homepage itself, wherein if there is slight mismatch, but if you give in your name and your date of birth and extra other details, the linking has become easier. Okay. So now that process having gone through, because there was a debate whether you would need to change the name in your Aadhaar card. Then you'll have to apply for a modification, and then you have to match it exactly the way it is on your PAN. So that was a time-consuming activity. Now that has been done away with.
So there is no need to go ahead and make changes in the information that are there in your Aadhaar card.
Absolutely. So you don't need to make sure that the name as spelled on your PAN card and that spelled on your Aadhaar card are the same. There could be slight mismatch. But that now the system is accepting it and they're linking it already. Okay. So the linkage of your cards have become easier now.
So gentlemen, it's quite clear that small changes or discrepancies in the name on both of these documents, PAN card and Aadhaar, they don't have to be a fresh source of worry. But what about in cases where, let's say, the address is different because you got your PAN card many years ago, maybe you shifted, changed, and the current address is a different address, and the Aadhaar sort of might have a different address. So in that case, can you still link both these documents, or will one of them have to be updated with the current address? Archit, you want to take that?
In the income tax return when you're filing, so definitely the PAN card will record the permanent address or the address where you were resident at, and the Aadhaar document will reflect the address where you may have applied for Aadhaar from. So in the income tax return filing, at least you can specify your current address or your permanent address. So the government so far has not taken a view on the mismatch of address address as far as I know. As Mr. Rungta pointed out, like there was a lot of grief around the name mismatch, which was a constant cause of grief. In fact, like on the income tax return side, if your name as specified on the income tax return does not match your PAN number exactly to the last spelling, initial, etc., etc., then the government does not let the e-filing go through. So I haven't seen concerns being expressed on address so far as per the reports which I have.
Okay, fair enough. On that note, we're going to take a very quick break, but there are a lot of other points that we have to cover. Recent changes that have come through which may or may not impact the ESOPs that you have, the taxation that's going to be levied there. We'll talk about that on the other side.
Central Depository Services India Limited, a leading securities depository in India offering services to depository participants and other capital market intermediaries, now enters the capital market with an initial public offering of over 35.16 million equity shares of face value of 10 rupees each. The 100% book building issue being offered in a price band of 145 rupees to 149 rupees per share opens 19th June, closes 21st June 2017. For risk factors and more details, refer to the red herring prospectus.
You're sure, na? We can go anywhere we wanna go, as long as the sun's shining, as long as the sun's shining.
0% alcohol, 100% madness. Sun-kissed fusions.
Heavy duty, long-lasting, highest-selling draw runners. Hetic telescopic channels for your draws. Load capacity 45 kg. Lifetime functional warranty. German quality. Indian price. Hetic fittings. German quality you can trust.
Profit from the emerging trends in the derivatives market and hedge yourself against volatile markets as we give you an update on the derivatives space. Murugappa Group presents Futures Now. Throughout the day, only on CNBCTV18.
Presented by Murugappa. Together, let's progress.
Welcome back. Here with Money, and we are talking taxes this week. So yes, tax filing season is around the corner. We just set the record straight on Adhaar and PAN and the linkage between the two. What are the other things that one needs to keep in mind, Archit, as we're getting ready? Because the ITR form itself has changed this year, right?
That's right. So I think like a few very important considerations, right? One, let's talk about like when folks have a business or they are filing as a proprietor or those kind of cases. So there was like there was a simplification in the ITR forms. So the government went ahead and reduced the number of ITR forms. So let me talk about that first from a business perspective as an individual running a business. So there used to be an ITR 4S and the ITR 4 for businesses. Now that has changed. The ITR 4S has been discontinued, but that is the form which where people could declare income under presumptive income. So it's a very popular tax form, and that has been renamed to ITR 4. So that's a bit confusing, but ITR 4S has become ITR 4. The erstwhile ITR 4, the last year's ITR 4 is now ITR 3. So this is a complex name change, but just stay with me. The other one is like the ITR 2A has been discontinued, and there's a new simpler ITR 1 and ITR 2 which has come into play. The ITR 1 is for folks who earn less than 50 lakh rupees income, do not have foreign assets, basically people who have simpler tax returns, which basically means you have income from salary, house property and so on, and you have a simple case, that's the ITR 1, and for every other thing it's ITR 2. For business you need to think about ITR 3 and ITR 4 now. ITR 4 is where you declare your presumptive income.
Okay, so important pointers to keep in mind as we're getting ready to file our tax returns, with of course the forms having changed to begin with. Now, Harsh, another slightly complicated issue, and this dates back to the budget day, because that's when the statement was made that if you have not paid STT or securities transaction tax on any sort of purchase or sale of shares, then there might be a case that you do not enjoy the exemption from long-term capital gains tax even after you've held those shares for 1 year. So there was a flutter in the market, and everybody was wondering what happens if I've got old bonus shares or ESOPs, prior to 2004. There is a clarification, I believe, that's come through. What is the current status?
The STT came into effect from 1st October 2004, and the purpose was that anybody who has paid STT, and you pay STT only when you transact on a recognized stock exchange, and if you held those shares for more than 1 year, then all the gains that you've made is exempt from tax. If you have acquired shares post 1st October 2004, you should have paid STT on both legs of your transaction. That is at the time of acquiring the shares and at the time of sale of shares. Now this is an issue, because now if in case you've been allotted shares through an ESOP, if you've got bonus shares, there is no instance of STT on those transactions. So to ease that, the government came out with final notifications now. So if I may just read out, because they will have exactly those words of the notification.
Sure.
All those acquisitions of listed shares approved by Supreme Court, High Court, National Company Law Tribunal, SEBI or Reserve Bank of India. That's the first. So all those shares which are acquired by a person as a result of some
action that's happened, or a regulator stepping in, and therefore you acquiring the shares.
So in that case, there is no chances of any bogus transactions taking place. So there is no element of evasion of tax in there.
Right.
So any shares that you acquired through such approvals,
you continue to get the benefit of the LTCG exemption.
Absolutely. Okay. The second condition says the acquisition of shares by scheduled bank, reconstruction or securitization companies or public financial institutions during the ordinary course of business. So they've exempted even those institutions from paying STT at the time of acquiring those shares. Now, as well, foreign direct investments and employee stock option schemes has been very specifically mentioned.
Yes, this was, I think, the important clarity that everybody wanted. Is what happens to your ESOPs, which the company gave you prior to 2004, and then if you go in the market and encash them, then what happens?
So exactly. So that has been categorically specified and said that any employee stock option schemes are exempted from this condition of having paid STT on both the legs of transaction. Now, acquisition by specified venture funds, of course, or investment funds or qualified institutional buyers, because the allocation of shares in such cases is directly by the company.
Right.
So there is no instance of STT being paid.
Right.
So these are the four categories that has been very specifically mentioned. Now there is an ambiguity on what about shares which are acquired otherwise. So in those cases also there is an exemption list which has been mentioned, and there are three conditions on that as well. Now in such cases, now the conditions that we're going to say is for those shares in which long-term capital gain benefit will not be given.
Okay.
In spite of the fact that you have bought it through and not paid STT at the time of buying. So now if you've acquired shares of listed shares in a preferential issue of a company whose shares are not frequently traded on recognized stock exchange. So there is a company that usually we see many times that there are thinly traded companies. They are listed on the exchange, but the trades do not happen in huge volumes. Now there is a possibility, and that used to be some cases that Income Tax Department has unearthed in the past, where shares were allotted as preference shares on a one-to-one basis. It was not
on an exchange, so there was no STT paid.
Absolutely.
So therefore those kind of transactions are going to be under the scanner.
Under the scanner, and you will not be eligible to get the long-term capital gains benefit. You will have to pay
long-term capital gains.
Absolutely. Okay. Another condition is if you've acquired shares of a company which is already listed, and then you have acquired it, like me and you get into a transaction to buy shares of, say, Reliance, for instance. While they're already listed on the exchange, why should we transact with each other?
We're doing off-market trades.
When we do an off-market transaction. So it says acquisition of existing listed equity shares in a company not through a recognized stock exchange. So while it's already listed, what is the need for you to buy and sell independently amongst each other? The third is acquisition of shares for company during the period of its delisting. So which means your company was listed, then it went into delisting, listing and then it listed back. In that period, if you acquired the shares amongst each other, not through the exchange because it was not listed there, still you will not be getting the benefit of long-term capital gains because you have to pay, in all such cases, you have not paid STT on both legs at the time of acquiring and at the time of sale.
Okay, fairly complicated but important to keep in mind depending on the transactions and the stock trades that people may be having. We'll take a break on that note. On the other side, we'll answer some of the queries that our viewers have and also give you a quick bird's eye view of what the onset of the GST could mean for your insurance and your mutual fund investments. Welcome back here with Money, 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 and this week we are discussing a couple of important updates that have come in through the tax world, whether it's your IT returns, Adhaar or PAN, or of course a couple of clarifications that also came in from the CBDT. Well, the other aspect that everybody is talking about now is what happens when GST sets in. So, Harsh, I want to ask you this because we understand that the rate, most services and financial services, the rate that is being applied is 18%. How does that change my life with respect to my mutual fund investments and when I'm buying an insurance policy?
So, well, Surbhi, while we considered all the financial services and it was in the service tax regime, we are currently in the service tax regime, wherein the rate of tax is 15% on all the financial services. Now, look at it from a GST perspective, it has been increased to 18%. So, invariably, let's talk about insurance first. So, whatever insurance policies you had, which are pure risk-based policies, which are your term plan, your medical cover, all those you're paying 15% service tax will now become 18% GST. So, your cost is going to go up by 300 basis points. Now, with respects to your savings-based policy, so you have either a term plan or you also have endowment kind of policies. Now, in those policies, you are paying a service tax of 3.75% in the first year, which was reduced in the second year to 1.87%.
Okay.
So, you pay, that is the rate you're paying on your premium, total premium amount.
Okay.
Because the savings element is also a part of your endowment premiums.
So, that was not being levied at a flat 15%. It was a much lower number.
Absolutely.
Okay.
Now this will also be increased because of the impact of GST at 18%. So now the first year, instead of paying 3.75, you're going to pay 4.5% as your GST.
Okay. And this is applicable to endowment policies specifically?
Any savings-based policies, which do not have a segregation of the risk premium and investments. So like if you had a term policy is a pure risk premium that you're paying. So on that you will pay 18%. In your ULIP policies, on all the charges that are amortized in your policy, you will be paying tax at 18%. However, in policies which are combined with investments and risk cover, the tax that you were paying earlier, the service tax was 3.75% at 15% calculations. Now that will increase to 4.5% in the first year. The second year, while you're paying 1.87%, the next year after GST it will be 2.25%. So there is going to be a marginal increase in your tax outflow in both these kind of policies. Now with respect to mutual funds, there is a cost that you're paying, the fund management charge. It's basically called total expense ratio, the TER. Now there is going to be an impact on that as well. Because as I said, it was a 15% earlier, now it's going to become 18%. So the total expense that you will be paying on your fund management or on the portfolio that you have will go up marginally by about say 3 to 4 basis points. So there will be some impact on that as well.
3 to 4 basis points, but that does not sound too dramatic.
Most importantly, and only time will suggest, is because there is an input credit facility also available. Now earlier, say a fund house had certain expenses on which they were paying VAT. Now they couldn't take that as an input credit for the service tax. Now with all the taxes coming together, and there is an input credit which the fund houses will be possibly able to take. So there is a great possibility that the actual increment will not be passed on to the investors.
Because the institutions start getting the input credit off the other taxes which they couldn't claim till now.
And with this anti-profiteering clause being very strongly advocated about and being enforced about, you cannot benefit out of any input credit that you're getting which you were not getting earlier. So there's a great possibility that the fund houses or the insurance companies may not actually pass on the cost to you and might take it over with them because they're also getting an input credit which otherwise they did not get earlier.
Archit, your thoughts on how GST might impact our savings and investments particularly?
So basically, I think strong concurrence on the anti-profiteering aspect, right? Like basically, I strongly think like that 3% spread may get covered just by the fact that there may be enough input credit to claim, and I think like everybody wants to not have an inflationary effect of GST on the economy. So like fingers crossed, but I think should not have a big impact on the retail investor.
Okay, fair enough. Well, on that note, let's also address some viewer queries that we've been getting. I believe we do have Mr. Roopchand with us on the line. Hi, Mr. Roopchand, can you hear me?
My status as an NRI, I was abroad for almost 30 years and I returned home on 1st February 2014 to India. So the first for FY 2014-15 and FY 2015-16, I filed my ITR under the status of RNOR. And all my interest on SCNR US dollar fixed deposits were shown under exempt income.
Sure.
So now this is the third year now for FY 2016-17. So should I show my status this year as resident instead of RNOR as in the past?
Okay.
And I should I have to pay tax on the SCNR interest with effect from FY 2016-17?
Harsh, now that he's come back and he is, pretty much staying in India, does he have to change his status as resident? And then what about those FCNR deposits? Basically there's a tax liability there, right?
Absolutely. So if you have come back on 1st February 2014 and after which your residential status, if it's no more resident but not ordinary resident, and you are a resident of India, in case your residential status has changed to that, then you must and you have to in fact file your returns as a resident. Now FCNR deposits, the interest that you were earning while you were an NRI, there was no tax implication on that, it's tax exempt. But in case your residential status has changed, then of course there will be a tax incidence on that. So it is in your interest that you file your tax returns with the exact residential status that you enjoyed today and pay all the taxes that are liable to in that context.
And could this be retrospective as well?
Yeah.
There could be a sort of a query on the FCNR deposits of the last 2 years as well?
So in case your residential status has changed in financial year 14-15 itself and you have filed your returns showing as NRI, then and you've got certain tax benefits as a status of NRI, and that was not a true declaration. In that case, there will be a tax implication from the year financial year 14-15 itself.
Okay, well actually we have run out of time, but thank you so much Archit and Harsh for joining in and taking us through, of course, some of these important aspects of changing taxation. That's why we'll take your leave. We'll see you again next week.